You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it. You got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, your Options Bootcamp drill instructors, Mark Longo and Dan Passarelli, will break it all down for you. Options Bootcamp is brought to you by tastytrade. Ready to shred your paper trades? Then trade at tastytrade, the broker that gives you what you need to make your own way. Get smarter every day with options education and research tools. Analyze your risks clearly with a potential profit and loss graph. Chart your way with hundreds of indicators. Make the numbers make sense and find the opportunities only you can see. Trade it with fewer clicks on an easy-to-use platform. Mobile, desktop, web. Supported by a trade desk with decades of combined experience. Stocks, options, futures, and more. You choose, you trade. Get what you need to make smart moves. Go to tastytrade.com/pod to see for yourself, genius. tastytrade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Fall in boot. It's time to get into peak options trading shape. It's time for Options Boot Camp.
All right, everybody. That music can mean but one thing. It is Education Wednesday. Once again, time to roll out another episode of Options Boot Camp. My name, of course, Mark Longo from the THE, optionsinsider.com, as well as from the network upon which so many of you are mainlining these days. Hope you're having a good trading week. A fun one, certainly a tumultuous one, a lot to unpack. Looking forward to a fun show this week. Before we get there, 3 quick things to remind you of at the top of the show. First off, we know the show's been running for over a decade, but a lot of new people are discovering the world of options literally every day. So if you want to help that process, make sure, if you like what you hear, leave a rating or review. Usually we go out there for our 5-star reviews to your usual platforms, your iTunes, your Apples. This is, as I recall, the first time I've seen a LinkedIn one, but hey, it's available on every platform under the sun. We say it all the time. You can get it on Audible. You can get it pretty much everywhere, including out there on LinkedIn. And this week's our 5-star review comes in from Don R., who just said, the best options podcast on the planet. Keep up the good work. Well, thank you, Don. Clearly a man of discerning tastes. If you like what you hear, you want to join Don, help new people continue to discover the content at the end of the day. Throw a like, a star, a comment, whatever your platform lets you do. Does help new people continue to discover the content. Of course, for all you new folks who are coming in, A, welcome. B, if you're just listening to Boot Camp, man, you're missing out. A whole network worth of shows, nearly a dozen shows coming at you over there. So make sure wherever you're getting this, again, could even be LinkedIn if you want. YouTube, Audible, who cares? It's available everywhere. Make sure you're upgrading to the full network. It'll give you nearly a dozen shows coming at you throughout the week. And of course, for those of you who are ready to turn your trading up to 11, you want to go above and beyond. You want an additional pro podcast feed. You want to join us live for this show. Everything else you do. You want to heckle Dan live here during the show. I get it. I want to do that too. Only one place to go to have all that fun. theoptionsinsider.com/pro for the place to go. Also giveaways, all sorts of fun over there. You folks know. You folks love it. Join us over there. We had a great pro Q&A yesterday with Scott Nations tackling some great topics in the world of vol. Coming up, options oddities pretty soon on Friday. always a fun look at the world of unusual activity. So check it out for yourselves, theoptionsinsider.com/pro. As we see who's joining us on the old Options Bootcamp Drill Instructor Proving Ground today. First, I am joined once again by my compatriot in all things options educational crime, the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the show. And what do you think about our buddy, Mr. Don R., who says we're the best options podcast on the planet? You know, obviously our listeners are a very discerning bunch, Mr. Dan.
Yes, indeed. He does have some taste, that's for sure. Thanks for the kind comments, Don. We appreciate it.
All right. And also joining us this week, once again, we are rolling out the Tasty Trade Hot Seat. It's fun. We're getting a nice array of perspectives joining us on the show each week. Last week, we had Jamal. This week, another newcomer to the program and indeed to the network. She is Liz Dierking, the senior options strategist over there at tastylive. Liz, welcome to the Options Bootcamp program and indeed for the first time to the Options Insider Radio Network.
Thank you so much for having me. To begin with, I got to say, I love your enthusiasm. Nothing makes me happier than people getting excited to talk and trade about options, trade and talk about options, because that's what I do all day, every day. So thank you so much for having me. I'm very excited to be here. I love what you guys are doing. It's a great podcast.
Well, thank you. We appreciate the love. And since this is your first time joining us here on the network, really quickly at the top of the show, let's do what we do with all of our first-timers. Why don't you give our audience a bit of an overview of your background in the world of options and derivatives, as well as what it is you do day to day over there at tastylive?
You got it. Thanks so much. Okay, well, number one, I'm a former floor trader. I was on the floor probably at the same time Dan was, because my partner that I do the show with every day. Well, I digress. But nonetheless, options trading is pretty much the only thing I've ever done. I went from college to the CBOE, where I stayed for about 12 years and traded in almost every single pit on that floor. So I have a lot of extensive knowledge from floor trading. And then after that was over, because that kind of, dried up a bit, I went over to the tastytrade side, which now for the last 13 years, I was one of the first people that started. Actually, I was part of the original cast of tastytrade. For 13 years, I host a live online show talking, trading, discussing options with one of my best friends that I've known for 14 years that's also a former floor trader. So we are two former floor traders that are females that talk every day, place trades live, talk through the good, the bad, and the ugly. And so that is longer than I care to admit. I've been trading options, but we're looking at close to 30 years. So
we're just lousy with former market makers on the show this week, which is always fun in and of itself.
And I would like to state for the record, I promise to not hang up on you 4 times like Jamal Chandler did.
I think he was having his own personal fast market last week when he joined us on the show. But yeah, it was fun. The snippets that we got were enjoyable.
I was laughing. I said, what is happening, Jamal? Get it together. So I promise I'm not going anywhere. You're stuck with me.
All right. Well, we're looking forward to it because we got a fun topic to get into today. So let's kick it off, listeners. A little bit of the old basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out. Do you hear me? Yes, sir. Basic to complex. Yes, sir. There will be no failures. Do you hear me? Yes, sir. Pull in. Yes, sir. Prepare to learn. Yes, sir.
All right, everybody, let's do it. I love it. It just feels like 4th of July or Flag Day every time we do this show here. It's so festive. Welcome to the basic training, the portion of the show where we break down some options, concept or technique or strategy in a little bit more detail, explain how you can utilize it in your own trading and indeed your own portfolio. And Liz, you know what? It is fortuitous that you join us this week because we received a question a while back and I had our producers go check it out. And it turns out, Dan, it was exactly a year ago. It was the show exactly a year ago. So I don't know what it is about this week on the show in November. People have Jade lizards on the brain. But someone wrote into us about a year ago and asked us, have we ever traded a Jade lizard and what are your thoughts? And Dan and I proceeded to have a lot of fun with it because we had no idea what the person was talking about. But we had a good time with it nonetheless. And it made for a fun discussion point on the show. But fast forward all that way to exactly a year later. How weird is that? And we are once again going to revisit that topic because I've heard a little birdie told me, Liz, that you are an expert on all things Jade Lizard. So let's just start there. What are we talking about? What the heck is a Jade Lizard?
Okay, thank you very. This is actually pretty fortuitous that this is happening. So the Jade Lizard, if you notice, just in the name, the Jade Lizard. My name is Liz. The girl I host the show with, name is Jenny, and it started off as the J Lizard. We created this strategy. So what had happened was in the up market when we were trading and the volatility was so low, and we're premium sellers selling straddles and strangles, we were getting killed on the upside calls, which I've heard you guys talk about before. So we created the strategy where you're selling an out of the money call spread and an out of the money put, where you're covering the width of the strikes on the call spread. So you have zero risk to the upside, but you're still selling both sides. So that in a nutshell is what the Jade Lizard is. So it's a neutral to bullish premium selling strategy. But it takes advantage of quite a few things. Now your viewers are very smart. So I think I can say this, but this strategy really takes advantage of the vol skew, because by eliminating buying the put, by just selling one put instead of buying it, you eliminate buying the most expensive volatility option on the board. So that is our baby, and the lizards have sprung from there. But yes, the Jade Lizard is probably one of my favorite trading strategies.
Well, there you go, Dan. We stand corrected 1 year later here on the show.
What did you guys say it was? I got to ask. I've listened to quite a few shows. I don't know if I exactly heard this one, but what did you guys say?
I think we had some fun with the name, as I recall, but yeah, I think we just guesstimated that it was some sort of upside premium selling strategy, but to what end? We did not know. I think Dan had the most fun with it. Dan, now a year later, exactly, sir, what are your thoughts on our revisitation of the Jade Lizard? Is it something you're going to incorporate at MTM going forward, sir?
Well, I am very glad that we got the right answer, right from the horse's mouth here. So we no ambiguity about it, which is great. And I'm going to take a closer look at it and toy around with it a bit.
I like it. So we, Jenny and I do, when we put an option strategy together, we have various kind of specific parameters. And it's easy because Dan and Mark, you guys know, we're all playing with the same deck, right? All we have is calls and puts, and we can buy them or sell them, and you can layer them to whatever your risk parameters are. But when we create a name for it, it's easy because Jenny and I know exactly what strikes. If I say, let's do a Jade Lizard in Tesla, her and I can come up with the exact same strikes because we know it's going to be the put is X amount out of the money and you're covering with the call strikes. So we name them, and you'll notice, and hopefully this comes across more, if you hear lizards or zebras or lots of names like that, they came from the Liz and Jenny show.
I like
to name them after animals.
Yeah, I like it. So let's walk through some scenarios here. So listeners, obviously this is, I guess you can call it a slightly bullish upside strategy. You're selling the put, and then you're also selling the call spread. Looks like you can do it actually with the goal, correct me if I'm wrong, Liz, is to do it with a net credit that ends up being greater than the width of the call spread. Is that the goal?
That is correct. Yes, you want your credit to be greater than the width of the call spread. So ideally, it was originally started just to give easy parameters. Say you're looking at a stock that is just around a 50. It doesn't work in low price products, but say between, $30 to $80 stocks. So you're looking at about 70 cents on an out of the money put and 30 cents on an out of the money call spread. And you try to get yourself as far away from where the product is trading as possible. So if that collects $1, that gives you a very wide range where you're going to keep all of your credit. And worst case scenario, you own the stock, the wheels fall out at a price much lower than where it's trading right now. It also helps out because when you're selling that put you're selling, it's almost as if you're getting it for an inflated volatility because you're adding an extra 50% onto the put that you're selling.
It's interesting. It's almost like a broken wing iron condor, I guess you can call it as well. You're not.
What?
That fourth leg.
You're absolutely spot on accurate. It is a broken wing iron condor because you're just not completing the iron condor by buying that put. But the key is to make sure that you're covering the width of the call spread so you have zero risk to the upside. So as the product goes up, this comes off for a profit.
Obviously, I'm assuming the initial risk management step is, okay, you're identifying a level where you're probably comfortable getting the stock put to you if it comes to pass. And then from there, you're constructing to make sure that your credits equal the width of the spread. Is that kind of the starting point?
Mark, that is correct. And I got to use something that you guys were talking about the other day because Jenny and I talk about it all the time. So your risk is managed at order entry, right? So when I'm looking at that product, I know that I'm going to put it into the wheel, as we like to call it, the wheel of fortune. But if something drops down and I get put that stock, then it's just into the wheel, meaning that I know what my next step is. If I get put the stocks, then I can sell a call against it and just complete that loop. But that's how we look at this: is your worst case scenario is you're long the stock at a much better price than it is trading right now.
Well, I like this as a starter leg to the wheel. If you've been listening to the show recently, we've been gone on a wheel tangent for months now. Our listeners have been all obsessed with the wheel, Liz. So we've been talking. I love
it. We love the wheel too. And it's funny because we say this is a great way to start the wheel, because you make money if it goes up, you make money if it stays right there. And if it goes down, well, then you're actually in the wheel at a better situation even than just selling that put. You get the extra credit from the call spread.
It amazes me since we started talking about the wheel. The wheel, a pretty basic, pretty vanilla strategy. I thought I had a handle on the basic use case and the way people utilize the wheel. And ever since we started diving into it on this show, also on our Advisors Options show, I have heard more different ways to utilize and set up the wheel in the last couple of months than I ever thought about. Using a put calendar instead of just a short put on the put side, in the money covered calls instead of the initial put. And now this, I kind of like this as a starter point, maybe the best, because people are always looking for that extra bit of juice, right? That extra bit of oomph when they're kicking off the wheel, making it a little bit more exciting, maybe make the initial premium harvest a little bit more attractive. This is a good way to do that without adding an infinite amount of risk. It's not like you're net short 50 units to the upside or anything like that, Liz, where you're going to blow them out. They can wrap their heads around this. And if they were intrigued by the wheel, but maybe they wanted an interesting or maybe more exciting starting point for the wheel, I could certainly see an argument for this. So I like it just for that alone.
I love it, Mark. Yeah, no, this makes sense. And this is how I start all of my wheels, if that makes you feel any better, because honestly, I never want to be put in the wheel. Wheel is worst case scenario, right? So with this, I prefer to just take my profits, close it, and put on another one next month, because that keeps me, just collecting premium. But the wheel is the worst case scenario, which isn't that bad of a scenario. So it's not a bad entrance.
The wheel, the gift that keeps on giving. I never thought we'd have months of content about the wheel when we first had some questions about it. I thought, this is the wheel. It'll last one episode. That's about it.
The wheel, because we call it the wheel of fortune, and we try to, old floor traders, and Dan can attest to this. We go, every time we jump into it, we say it's the wheel of fortune.
I like it. We call it some folks call it the triple income strat. I never liked that. I often call it the wheel of fun, and or just recently the wheel of death, just to make it more exciting for some of our listeners who are maybe getting bored hearing about the wheel all the time. But yeah, there's a lot of wheel of fortune. It also implies, there you go, listeners. If you were a lot of the people who were writing in on our wheel trades alone just recently and saying, hey, what's an interesting additional way I could maybe turn my wheel up to 11? Well, there you go. We've gone, Liz, you've converted us. A year ago, we were mocking, we were not at all receptive to what our listener, what was it, EL33T, what they were putting down. And now you've come on exactly a year later. And I always say Dan's the black-headed one, but you have now lured us to the dark side of the Jade Lizard. So congratulations to you.
I love luring to the dark side. This is so much fun.
Dan, any other thoughts on the Jade Lizard before we tackle a mountain of listeners?
Yeah, I just want to qualify one more time. So you said that you take in, is it a certain percentage more on the short put than the call credit spread? What was that again?
So you can go however you want to do it, but the rule is pretty much like loose. All these are loose-based rules, but we just expanding from the dollar-wide strike. If you're looking for 70% on a put and 30% on a call spread. So if you're doing a $5 wide, you can use those same parameters. But I was just saying the Jade Lizard really sets up in things that have dollar-wide strikes. So you're going to get 70 cents on a call and 70 cents on a put, the out of the money put, and 30 cents on a call spread. So you've covered the width of that dollar-wide call spread. Now, you can take that and adjust it to your 250 strikes, your $5 wide strikes, but typically around 70% of the width of the strikes on the put and 30% from the out-of-the-money call spread. And Dan and Mark, you guys both know this, but when you're doing out-of-the-money call spreads, that'll get you to right about the expected move for that cycle when you put that out of the money call spread in there. So you just want to give yourself a little bit of room. So this is truly a premium selling strategy where if it stays right here or goes up, because there is quite a bit of room in that, you're going to make some money.
That's great, man. That's really cool. I love, when there are very specific parameters, even though, like to your point, there is flexibility and you can kind of, make it your own, I guess, if you will. But I think it's very helpful that when people are starting out with any strategy to, just say, hey, look, here's the baseline, and you can kind of go from there.
Right, and that truly is. It is just a baseline. But the whole crux of the Jade Lizard, to be honest with you, is to make sure there's no risk to the upside. Because I was listening to some of your scarier episodes, like Halloween episodes of the scariest things, and to me, it's naked calls. I shudder every time I think of it.
Yes. I think there's two ways to go, like the actual risk, and then, of course, the one that sounds the scariest, which is, of course, the strangle. And
okay.
So we had two ways to go. But yeah, naked risk was definitely on our board. Speaking of naked upside risk, I can't imagine a better stress test scenario for this strategy, Liz, than back in the meme stock explosion of 2021. You had GameStop, AMC, and everything else just exploding 300% at a clip. I'd imagine this strategy was interesting during that time. You probably had some interesting takeaways from it. And also, I guess the fact that you're still here talking to us, you didn't blow out entirely, is a good example that the strategy can survive.
Mark, the Jade Lizard is perfect in these situations. Absolutely perfect, because this is exactly why it was invented, right? So you want premium selling strategies. So those meme stocks had all this crazy premium, but they shot through the roof. Well, in a Jade Lizard, you can't lose to the upside. Now, you don't make any money once it crosses your strikes, but you don't lose any money because you've covered the width of the call spread. So in the meme stocks, we've had so many people come up and say, thank you for the Jade Lizard, because it's still premium selling, but you cannot lose to the upside if you cover the width of the call spread with the premium you're collecting.
That's why I wanted to bring that up for people, because I know we're going to get the mail after this. What about 2021? So I wanted to state it here on the show that it can survive because you're collecting premium to cover the credit.
It's probably the only premium selling strategy that could possibly survive, and probably did survive, those meme stocks. Because and that's why I shudder when I say naked call, because if you have a naked call on in those, you're taking heat in lots of different perspectives. And it's hard to kind of defend that. But in the Jade Lizard, an up move, now I just want to be very clear, in a massive up move, you're not making any money, but you're also not losing any money. And that's something that's kind of music to my ears in one of those situations.
And it's fun because I'm sure Dan has in the past, we've legged into this exact strategy in different, without knowing we were trading a Jade Lizard at the time. So now I know what I'm doing, which is fun. It has a cool name to it. Also, I probably wasn't constructed at the outset to exactly cover the width of the spread. So that's also intriguing. So listeners, you probably have traded a Jade Lizard yourself without even realizing it, which makes it more fun as well. Speaking of the listeners, Liz, I hope they prepared you, because it's time to bring them on a little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, we got a lot of listeners coming at us here. Right at the top of the show, really quickly, Liz, sometimes guests come armed with a question. You're always engaging with a lot of your listeners over there on your own show. If you have an interesting or salient question that they've thrown at you lately that you thought was interesting, maybe worth discussing on the show, have at it. The floor is yours.
Oh, gosh, I didn't come armed with a question, but I will come up with one right away. So you know what I get all the time? And we just recently came off a tour where we went to Denver, Colorado, and met a lot of our viewers, which is great because we interact with them via Twitter, but you guys have a lot more touch and feel with a lot of your listeners, which is great. But a lot of people that were new to the show asked me, and I would like to hear your guys' opinion on this. If you're going to teach your wife or your daughter or your nephew or your cousin how to start trading, what strategy do you start with? And I think my answer is always going to be the naked short put, which is which a lot of people think is the riskiest trade on the board, but that's the one that I got asked a lot this week. If I was going to teach somebody else who isn't, maybe more of a beginning options trader, what's the strategy that you would teach them? And I always say with naked short put. What are your thoughts?
I like it. I also know from experience that it scares the hell out of people when you first say that way. So I try to flip it. I flip it around. A lot of them usually have equity exposure anyway. So I think it's a little bit of a sip of water for them as opposed to the whole deluge, just to say, okay, how about a covered call? And I've had better success bringing people to the dark side over time with that, I think, because they see the value in that. A lot of them are already maybe trying to collect some dividends on their own anyway. You approach them and say, hey, what about if you could create an additional income stream, a dividend stream on this underlying? And they say, oh, interesting, tell me more. And then you start going down the rabbit hole. Obviously, risk-wise, it's the same thing, but it's far more palatable, I found, to a lot of people than shoving them off the deep end of the pool and say, hey, go swim.
Well, the funny part is, though, those are two different answers to the wheel. So both of those.
Yes. Yes. I guess if you want to, the wheel is a good way to go too. It's a lot of moving parts. It might be overwhelming, but yeah, I think you can't go wrong with either of those. Dan, you answer this question a lot over there at MTM. What is your choice for the year? Your favorite starter position for new people? You go to a dinner party or maybe a family member and you want to lure them to the dark side. What's your starter position?
I'll tell you, I would probably just say something like buying calls with lots and lots of caveats. Like do that first so that you understand what an option is, and then quickly stop doing that because you're not going to make money in the long run.
I was going to say, don't do that anymore after the first one.
Right. It's funny, Liz's answer, like 10 years ago, if somebody would have asked that question, I would have been like, you'd be crazy selling puts. Are you nuts? And then it took me a long time. Sometimes I'm a slow adopter, but I can see that answer and I kind of like it. So I really come a long way. And, that's notwithstanding what we've talked about in the past on this show, what I've talked about where, that comes along with an objective attached to it. You've got to not just be okay buying the stock, but actually probably want to buy a stock and have a secret hope that you buy the stock. And your biggest disappointment is you skate and you get to keep the money.
Correct.
There you go, Liz. I can tell you're a pro because I kind of threw you to the wolves and you roll with the punches like it was nothing. So very impressive out there.
Can I tell a little fun story? Well, it's not that fun of a story, but Dan was just talking about how you secretly want the stock. So I recently went on a Royal Caribbean cruise, and I found out that if you own the stock in your account, they will give you stateroom credit, and you just have to prove that you have it. So all I wanted was to get the stock. So I kept aggressively selling puts and aggressively selling puts and aggressively selling puts, and I wound up never getting the stock but paying for my cruise.
I just love it. It shows how much of a hardcore options trader you are because you need the stock for the credit and you still just won't go out and buy the stock. You keep selling the puts. I love it. That shows how much of a degenerate you are, and I appreciate it on every level. Dan, Liz, roll with the punches pretty well. Let's see if you can match that. What is your market taker question of the week, sir?
I get this question asked on a regular basis. I got it asked this week just about what a good strategy for trading the VIX is, and we've talked about a number of these. I think we've done a couple of shows on some of them, so I won't go down too many rabbit holes. But I think with the most important thing, with any trading, with anything you want to get an edge or an advantage on, even outside of trading, is to find a little nuance, a little niche, a pattern, maybe, if you will. And, there's a number of those with the VIX and all the VIX products. One that I'm just thinking about now that I don't know if we've thrown out there before is just that it's rather common on Fridays to see the VIX actually at a lower value relative to the rest of the week statistically. I don't know if I've done a study on this in many, many, many years, but the logic behind it, but regardless, I think it'll still work out that way. The logic behind it is that when the weekend comes out, basically the mathematical models don't know the weekend's coming out, and so it just kind of looks like lower volatility on those Fridays, and then back on Monday tends to be a higher volatility day because it sort of recalibrates. So there's just like lots of little nuances with the whole volatility suite, and it's not for everybody. But for those who really want to dig in and look at some of the nuances on this stuff, it's you're never going to be at a loss for things to think about.
Speaking of digging into the nuances, that's a perfect segue to our next question here. Actually, a bit of a follow-up. And, we're having all this fun, so I kind of feel bad about bringing up this topic because it's going to bring the energy level down a little bit, I think. But this is a follow-up, Dan, to a question we had, I want to say a month or two ago here on the show. It came from Crazy 8. He asked about pattern day trading rule. Does it apply to options as well or just stocks? And we got into the pattern day trading. We talked about a little bit of fun here on the show with it, but also kind of the nuts and bolts of it. A lot of people responded to that episode saying they've bumped into it in the past. A lot of you wrote in with your own workarounds using the E-mini. A lot of you also said at the end of the day, if it hits you, not that big of a deal. It's just, the worst case, it's a 90-day flag, and then you get to come back and you gotta do it all again, and you could kind of keep resetting every 90 days. So the gist that we got from a lot of you was that it's annoying, but it's not that big of a deal. You could work around it with the E-mini, and if you do get hit on it, it's just a 90-day hit, effectively. That was the way I thought about it. That's the way Dan thought about it. That's what we talked about here on the show. It wasn't until actually this Monday. We were joined on our Option Block show by actually the CEO of tastytrade over there, Mr. Scott Sheridan, and he kind of shined an interesting new light, maybe a disturbing new light on what's going on with this pattern day trading rule and the way it's being enforced. So rather than put words in his mouth, I'll let him spell it out for us, then I want to get your thoughts on it. Here we go.
And the rule, as it used to stand, depending on the clearing firm where you were trading, they either gave you one reset a year or one every 90 days. So a reset would mean if you made more than 3 day trades in a rolling 5 business day period. So if you made four is the same as 1,000. It doesn't make a difference. If you violate, you violate. You would need to get your what's called an equity maintenance call, an EM call, and you would need to ask your clearing firm for a reset. If you have one, they give it to you and you're good to go the next day. About a year ago, FINRA changed the rule. Again, they're saying they didn't change the interpretation. The rule now is that you get one violation in the life of your account. Let me say that again. You get one violation, and then if you do it again, you get a warning, you get a violation, and you're done. So what that means is if you are a tastytrade customer, if you're a Schwab customer, a Fidelity customer, it doesn't matter where you're trading. If you are under $25,000 and you make more than 3 day trades in a rolling 5 business day period, you get a warning. You can get a reset. If you ever do that again while you're at that firm, you're done for the rest of your life.
That was shocking to me to hear that, quite frankly. Apparently, it's not a new rule. It's FINRA is interpreting an old rule, the old rule, in a very new and seemingly very stark way. So I know Scott's kind of assembled a coalition to fight against it. Sounds like he's fighting the good fight. But I wanted to give our listeners an update on that because the takeaway from that episode a few months ago was that it wasn't that big of a deal. Now it clearly is a much more stark thing. You could get effectively kicked for life until you bring your margin, or I should say your account level up from a broker that you like quite a bit. Dan, you and I were kind of had some fun with this on the show, but it didn't seem at the end of the day like it was that big of a deal. What are your thoughts on this kind of stark new interpretation of pattern day trading? It's effectively one strike and then you're done for life, sir.
I got to jump in here too. I apologize, but I think this is a pretty antiquated rule, and I really am in shock that they walked it back as far as they did, because you're really this is really challenging people that are trying to take profits. If you're trading options in a defined risk capacity, you can really up your pattern day trading rules. So, I mean, we say on a daily basis, with the new commission structures, you want to take your profits because you can't bank anything until it's yours. Well, this is really going to put handcuffs on people that are going to be trying to take their profits. There are workarounds, though. And to understand the rule, you must understand the rules in order to understand the workarounds.
Yeah, and I'll jump in. I mean, yeah, that's exactly the whole point. I mean, man, look, it's not their fault. The people at FINRA, they're trying to do something good, I'm sure, but sometimes they make these rules that they think are doing good, but they really end up hurting people more than helping them.
Yeah, kicking a customer for life from a platform. I have a hard time seeing the end benefit of that. That said, we did put it out to our audience. You folks are the ultimate arbiters at the end of the day. We did a little bit of a flash poll around Scott's appearance on the option block on Monday. And we asked you quite simply, is the pattern day trading rule a necessary protection for retail traders or an outdated concept that needs to be updated or removed? Nearly 85% of you said, no, it's outdated, get rid of it. And 15% saying, yes, it protects traders, including a few people who were kind of surprising. Our buddy, Mr. Jim Carroll, a.k.a. @Vixologist on Twitter, always putting up some great stuff about vol and VIX. He chimed in to say he personally thinks requiring some minimum amount of capital is a good idea. So he's actually on I was surprised 15% actually came in favor of pattern day trading. At the end of the day, listeners, you can obviously avoid all of this by putting $25,000 in your trading account. But for a lot of people, that's easier said than done. That's the price of a small car. I mean, that's not a small amount of money at the end of the day. So this is really targeting a very small capital level subset of the audience out there. So Liz, your CEO coming on and awakening us to an interesting new wrinkle in this pattern day trading. Again, not the most fun of topics, but I think something we definitely needed to update our listeners on.
I agree. And they've been, over at the tastytrade, they've been fighting the good fight for a long time, trying to get this rule changed. I understand where people are coming from, thinking there should be a minimum requirement, and maybe it's stopping people that aren't learning about what they're doing before they're trading. But I think if you understand a little bit about options, they're not as scary or as risky. I think they're less risky, but that's just my perspective because I know how to trade them responsibly. So I think it's a rule that I wish people would fight more, because I think that you guys are doing a great job of this, but options trading is in its infancy, and I think it's going to explode from here. Now, granted, I'm very passionate about it. I love it. It's everything I've ever thought. But the more people get into it, the more people can learn about it. And I think that rule is pretty antiquated.
Let's hope calmer, cooler, saner heads prevail over there in Finland, and we could move away from that sort of dire draconian implementation of it. I don't really see the benefit of that. CB chiming in on our poll saying limiting someone's liquidity is never the answer. I could see an argument to limiting options trading for lower accounts. Yeah, maybe that's a way you could go about it. Maybe only level 1 or no level 3 for under $5,000, something like that. It's definitely a surprise, and one we wanted to remind you of here on the show, because a lot of you listeners of this show in particular fall into that newer category, and so might find yourself bumping up against this pattern day trading rule. And again, if you do it once, okay, after that, that's it. So bear that in mind if you're doing this. Let's move back to some more options specific questions. This is the fun one from Wolfpack, one of our pro members. He's chiming in here this week to say, can the Options Bootcamp crew weigh in on the great SPX put spread debate that was started on the pro Q&A session last week? Are they really so ineffective as a hedge? Thanks so much. Well, great question, Wolfpack. As you're a pro member, so you were there, you listened to it. For a lot of our listeners here, maybe you're coming to this for the first time. We had a great pro Q&A session with our buddy, Mr. Bill Ulivari, longtime market maker and risk manager down there on the SIBO, now manages capital over there at Senecal Capital Management. He made an interesting comment about someone asked him about SPY put spreads. And, well, I won't put words in his mouth. I'll let him give his answer, and then we could discuss it here on the show.
Okay, I can only tell you from being on the floor as a floor trader from 1982 until 2012, and that is you never buy put spreads in SPY, because SPY declines in price. The downside put skew picks up in value, and so when you buy put spreads, the short side is what gets jacked up the most, and it doesn't really provide the type of downside protection that you would normally think, and so what normally you would do is you got to be really careful how you run your delta, how you really model your options. So I guess if you had a small position in SPY, I would say, okay, that's fine, but you're probably better off like selling an at the money call and maybe buying a downside put to keep your initial outlay a little bit lower. I'm just saying that there are legions of traders that were carried out in the bankruptcy world by the bankers. They blew out kind of ambulance. Why? Because they own put spreads, and their modeling program would tell them that they were short, but they kept losing money every time the market was going down. Well, why was that? It looked like you were delta short. It looked like you should make money. You click your button, and it shows you a P&L graph of what the what if scenario is going to be for your portfolio, but it never worked out that way, because you're long and at the money put, which is riding down the scale of skew, and your short put is going up the skew, and you just don't really make that much money in put spreads versus your SPY position. So,
all right, that comment obviously set off a lot of interesting debate on our network, and a lot of our listeners, too. A lot of you love yourself a good SPY or SPX put spread, and Bill throwing some cold water on that, which I thought was kind of fascinating. Liz, as our guest, I'll get your thoughts first. What are your thoughts on that in general? Do you agree, disagree? And then where do you fall on the whole SPX, SPY put spread debate? You a fan, not a fan?
Well, it's pretty interesting that we're talking about this right now, because even in the Jade Lizard, if you notice, I mentioned that type of trade helps with your put skew, right? So because it's that same concept of put skew, and I don't disagree conceptually with what he's saying, because as if you're using it as protection, if the SPY is going down, implied volatility in those options is going up. So you're not going to make as much money on your protection as it would originally say. Like he said, if you press the button, you can look at your P&L graph and if it goes down. But that's in a bubble of the implied volatility. As SPY goes down, the implied volatility of those options goes up. So you're not getting the one-for-one protection that you think you're going to. It's not in a bubble. So I don't disagree with him. So if you're looking at a hedge, there are other ways to hedge a long portfolio.
There we go. Mr. Dan, same question for you, sir. It's become a contentious hot button topic. Who knew? Put spreads and SPY, such a contentious thing. Where do you fall on the great SPY put spread debate, sir? Yes, sir. No, sir. Where do you fall?
I mean, generally, I've always been not a fan of using put debit spreads as a hedge for anything. For just really a simpler, more straightforward reason is that they're just sort of a partial hedge. And then if you are going to use it as a partial hedge, it comes down to strike selection. And what you really, really want to do is buy the highest strike you can to get the most protection you can and sell the lowest strike you can. And if spiders fall very close to the short strike, that's kind of when your Greeks flip-flop a little bit, because the closest to the money option has the dominant Greeks. So, you end up actually short Vega, and this is to his point now, you end up short Vega, and implied volatility goes up. But, that said, if you're selling, I mean, you never want that short strike to get into the money anyway. So it becomes a moot point if and only if you can select the exact perfect strikes with your put debit spread, which you're never going to.
Sounds like it might be a good topic for a full episode. Maybe we'll have to invite Bill on the show. Maybe we'll bring Liz back too. Why not, Dan? What do you think? And we could have a whole fun, the great SPX, SPY put spread debate. I think that would be a fun topic for a show. Speaking of fun, we're having a lot of fun. We're coming up against it already, but you know what? Let's squeeze in one more here just for fun. Let's go out to the creatively named 884WL. I have no idea what that stands for. They say, when is your preferred time to trade straddles? I'm looking mostly from the long side, but if you prefer to trade them short, then I'd be interested in that as well. Well, interesting timing, 884WL. I was joking earlier about the ideal time to stress test the Jade Lizard to the upside, of course, would be in the meme stock palooza of early 2001. Everything's ripping to the upside. That, on the flip side, is also a great time to be long some straddles. Anything where the market is exploding in either direction. I don't care, pick one. March 2020, also another time. Selling off aggressively, bouncing right back up. Those are the times when long straddles, that kind of long at the money premium, is worth its weight in gold. You're going to make money on that pretty much in any direction. You just got to buy it and strap in for the ride. If you go back and listen to our network, that's probably one of the few times on this show, maybe on OPR and a few others, that we really talked about long straddles in any sort of really positive capacity, and actually had some interesting trades and recommendations along those lines because they were working in that environment. Outside of that, long straddles are usually kind of a death by 1,000 cuts, but in those kind of environments, they can be interesting. Liz, where do you fall on the long straddle? Do you like them? And if so, when is your preferred time? What's your preferred use case for them?
Well, I think that was well said, and you actually have to time the market if you're going to be long straddles, because it is death by 1,000 cuts. And time again, if that's your preferred method of trading, you're probably going to lose over time. But so with being long option premium, it's just going to go in your face and decay because it's just a low probability strategy. But if I have to answer this question, I will tell you, sometimes you can buy a straddle the night before earnings and sell the straddle the day after earnings. And I don't know if that's what you guys were looking for as far as timing of those, but other than that, you have to have your market timed perfectly. You need a massive move in one direction or the other, because the volatility We know in efficient markets, because we've all been trading this game for a long time, you've got a lot of efficient players in there, and they are pretty good at saying how much they think it's going to move up or how much they think it's going to move down. And those straddles are pretty perfectly priced.
Buying straddles before earnings. I didn't know you like to go to Vegas a bit.
I usually don't do that.
I like it.
Don't let anybody hear that. But that is the one time that you'd have to sell it out on the open, because it's, to your point, what you were saying is if you're looking for a massive move that you think is going to be outside, it only happens occasionally.
I like it. Mr. Dan, sir, because I'm a nice guy, you get the last word on straddles, sir. What's your preferred? I think you were even talking about long straddles back in early 2021. Is that your preferred use case, your preferred time frame?
Yeah, I just went, Liz, don't worry, nobody's ever going to hear that. So, yeah.
It's just the three of us. It's only the three of us. No, I usually do not do that, but there have been times when that is the only way to do it, because you got to time the market.
Yeah. And, I've said many times, straddles are tough to trade. And there's nothing wrong with it. I've actually got one on right now, but the thing, yeah. I know. And most of the time when I do, it ends up being like, man, I shouldn't have done that. And you have to get used to that if you're going to trade straddles. Like, I can guarantee you most of them are not going to work out. And that can be psychologically difficult for a lot of traders. But there's a lot of trading strategies where you have way more losers than winners, but it can still be a viable strategy. So, you just have to have your right parameters, the right attitude going into it, and really pick your spots and use it sparingly.
Use it sparingly. I second that. I would like to second that. It is tricky, but I also think it has a good resume on paper, which lures a lot of newer traders into it, right? Mm-hmm. Meaning, hey, it can go up, it can go down, and you have unlimited profit potential. That's a real good resume on paper, but I agree with you. Use it very sparingly.
That was one of the things when we first launched the Options Insider in this network way back in the primordial ooze days of 2007. We used to still see the late night infomercials, make money in any market condition. They wouldn't say straddles, but that's what they were hawking. And it was a very popular kind of late night infomercial fad there for a while. So one of the early things of the network was trying to combat all the FOMO and all the just the FUD around straddles that was floating around. We kind of moved on. Iron condors, maybe jade lizards are the sexiest thing now. I don't know. But intriguing stuff nonetheless. Unfortunately, Liz, that music means we have come to the end here on this week's Options Bootcamp. I had fun. Did you have fun?
I had a wonderful time. Thank you so much for having me.
Well, we enjoyed it. I can't speak to Dan. He's kind of a bit of a grump. But I had a good time here on the show. And Liz, I'm sure a lot of our listeners are already familiar with what you're doing over there. But in case they're not, hit us up. Where can they go check out all the stuff you got coming out there?
Yeah, visit tastylive.com. My show is the Liz and Jenny Show. We are live Central Standard Time from 10 to 11 a.m., but the entire network has programming from 7 a.m. through till about 5 o'clock now. So please come on and check out Tasty Live. But honestly, if you're listening to this, you're in good hands because these guys are a lot of fun and know their stuff.
Well, we appreciate that. Always fun to get a nice review from a guest and a co-host as well. So check them out over there, Tasty Live. Maybe trade a Jade Lizard. Let her know what you think of it over there. You know, we were skeptical at first, listeners. We've been turned to the dark side, and maybe you will too. And Dan, you live in the dark side 24/7. Where should folks go if they want more MTM in their lives?
Yes, sir. Market Taker mentoring 2 T's in a row. And we'd love to hear from you. Come join our community and join our chat room for free right now. And we'll welcome you.
MarketTaker.com. Don't forget the second T for Theta. Check out what Dan and the crew have cooking over there. That's usually it for us on the network today, but not today, listeners. A lot of you have been asking for the return of a very specific show, actually very relevant to this show, very much a sister show of this one, a very much educational-oriented program, and it's been on hiatus for a little bit, but I'm pleased to say Options Playbook Radio making its triumphant return. Coming up in about exactly an hour, I will be joined by the Options guy himself, Mr. Brian Overby. Going to be holding court. Got some new stuff going on over there. New stuff, maybe some new plans for OPR. So stay tuned for that. It should be fun. If you're listening live, of course, hang out in the live. We'll be back in a little bit for OPR. If you're listening after the fact, of course, you'll get it on the full network, which is why it's so important if you're not subscribed to the full network. What are you doing, listener? You're missing out on nearly a dozen programs. Check that out on your platform of choice. And, of course, if you want access to the pro Q&As, you want access to Options Oddities, you want to join us live for this show, everything else we do throughout the week, the giveaways, all that fun, only one place to go, theoptionsinsider.com/pro, the place to go to learn more. So back again in about an hour for OPR. Back again tomorrow, of course, for our double dose of the option block with our friends over there at CBOE, followed immediately by This Week in Futures Options, talking about everything going up over there at CME this week. Friday, volatility views. Then we're back again for all you pro folks with Options Oddities. And we're back again next week, all the way through to next Education Wednesday, another episode of Options Bootcamp. Stay safe out there, everybody.
Options Bootcamp is brought to you by tastytrade. Ready to shred your paper trades? Then trade at tastytrade, the broker that gives you what you need to make your own way. Get smarter every day with options education and research tools. Analyze your risks clearly with a potential profit and loss graph. Chart your way with hundreds of indicators. Make the numbers make sense and find the opportunities only you can see. Trade it with fewer clicks on an easy-to-use platform. Mobile, desktop, web. Supported by a trade desk with decades of combined experience. Stocks, options, futures, and more. You choose, you trade. Get what you need to make smart moves. Go to tastytrade.com/pod to see for yourself, genius. tastytrade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.